Even if markets crashed, and in the past when markets crash, you see both gold and silver drop in price. Even if markets crashed, I don't think you'll see silver ever under $50 again. I don't think you'll ever see gold under maybe 3,800 again. But the risk of waiting, hoping, and hope, by the way, is for dopes. When you're talking about finances, you don't hope, you look at things mathematically. Hoping to get lower prices is a fool's game. I mean, you're going to count your wealth in ounces, not dollars.
The past year has revealed a clear turning point in the global financial system, with leverage and debt continuing to climb, while the tools that once supported asset prices are beginning to fail. As liquidity conditions shift and long-standing mechanisms such as carry trades unwind, markets are increasingly signaling stress beneath the surface. Bill Holter has emphasized that commodities and precious metals have been reacting not to headlines, but to the growing realization that servicing massive debt loads will ultimately require aggressive monetary expansion, pushing tangible assets into a leadership role as confidence in financial engineering erodes. One of the most important changes has been the behavior of metals markets themselves. Physical demand is asserting dominance over paper pricing, with signs of backwardation emerging as buyers demand immediate delivery rather than future promises. This shift reflects declining trust in leveraged contracts that have historically influenced prices without requiring real metal to change hands. According to Bill Holter, decades of price management through derivatives are losing effectiveness, opening the door for gold and silver to trade more freely in cash-driven markets where scarcity, not leverage, sets value. Looking ahead, the implications are profound. As confidence weakens across currencies, bonds, and even information sources, precious metals stand out as anchors of trust in an increasingly uncertain system. Holter argues that waiting for a return to past price levels may prove costly, as availability rather than price becomes the real constraint during periods of disruption. In an environment where paper claims risk losing credibility, physical gold and silver could move rapidly into higher price ranges, not gradually, as markets are forced to reconcile decades of imbalance in supply, demand, and monetary integrity. Now, we present the clips from Bill Holter's interview with Liberty and Finance. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Backwardation worldwide. And what that means is people want their metal. They want it in hand. They want it and they want it now. They're not willing to wait 30 days, 60 days, 90 days. And that's why you're seeing markets that are paper markets are trading below markets that are physical markets, price-wise.
And do you believe that switch in emphasis from paper markets to physical markets is what you've been talking about for a long time? Is this one of the steps that you've been telling people to watch for? And what do you think how will that affect the price action of gold and silver because of that change?
Well, understand that the price action for 30 plus years has been managed, if you will, with paper contracts, with leveraged paper unbacked contracts. And that is ending. So from a price standpoint, I think you're going to see both gold, silver, and other commodities liberated and trade as they would in cash markets, where there's no interference by futures, options, etc., trying to in the metals market trying to suppress. And then it goes the other way around in the paper markets. When I say paper, I'm talking about stocks, bonds, things like that. Those same derivatives have been used to hold the markets up. And I think that the paper influence is waning at this point. The point in time where it's done, that's where you'll see markets crash and gold and silver basically become unobtainable. Well, like I said, the action on the exchanges are changing because it's moving. They're all moving more toward delivery. They're all moving more toward a cash and carry market. Now, COMEX was not designed as a cash and carry market, and you can see the inventories have declined, especially in silver. You can see that with LBMA. You could see that with Shanghai, even though Shanghai is basically a cash market. But I've been adamant all along is that the end game, gold and silver would end up being cash markets, cash and carry, and the futures would be irrelevant. I mean, it's very possible to see gold at $50,000 or $100,000 bid and nobody willing to sell. Yet COMEX has got gold contracts offered at $10 an ounce, but nobody's willing to buy them because there's no gold behind them. So I mean, that's where we're headed, and that it all ends in what I've talked about for so long: a failure to deliver. Somebody stands for their metal, and that metal doesn't exist. They can't get the metal, and then it's completely game over because confidence will be 100% broken. Understand the dollar itself, the euro, the yen, the pound, they're all fiat currencies, and they all are valued because of confidence. Confidence goes another step further. The reason, and going back to the reason governments don't want gold and silver to go higher is because that shows a lack of confidence in their currencies, and it makes it more difficult for them to borrow. The suppression scheme on gold and silver really started in 1996 with Robert Rubin with what he called the strong dollar policy. And the strong dollar policy basically was dollar good, gold bad. And, they were able to, for years and years, they were able to put a collar on gold and silver. That collar is breaking, and as that breaks, so does trust. And you're right, there's so much, it's hard to tell what's real and what's not real. I posted the young Korean guy on my website and got about 5 or 6 emails immediately back saying this is AI. And I said, yeah, I know it's AI, but his logic is sound. Now, the only thing I've heard him or it or whatever say that was speculative and it looks like was not true was the CFTC meeting at 9 o'clock this morning, telling people that you can't buy, like the Hunt brothers back in 1980. But his logic on that was, in my opinion, was 100% correct. If the COMEX comes out and tries to pull the same bullshit they did with the Hunt brothers, where you cannot buy, you can only sell, that will be the end of the COMEX contracts, because that will immediately, people will immediately buy every physical ounce of silver, every physical ounce of gold that they can find. You'll see that bifurcation between paper and gold come to 100% fruition, and silver. Gold and silver have been bought, and the deficits, the supply deficits, have been exposed, not because of Americans. I mean, as a broker this year, we took more sell orders from clients than we had combined in all the years of our careers, or at least I did. I mean, I took tons and tons of sell orders this year. So North America was a seller, yet the price of gold and silver exploded higher. And the reason being, you had central banks from all over the world buying. You've got India importing massive amounts of silver. China's a huge buyer. Russia's a buyer. And mentioning Russia, this whole thing got kicked off when Biden tried to weaponize the dollar, the SWIFT clearing system, and confiscate the 300 plus billion that Russia had in reserves. And those are still confiscated. And the world looked at that and said, hey, wait a minute. If they can do that to Russia, they can do that to anybody, including me. And that's why you've seen sales of treasuries and purchases of physical metal delivered out to these entities.
Bill Holter frames the current state of silver as the result of long-forming structural pressures finally starting to surface, rather than a reaction to any single event or short-term narrative. He points out that while headline prices can appear calm or even misleading at times, the real movement is happening beneath the surface, where physical metal is steadily migrating away from traditional Western markets toward regions and institutions that prioritize direct ownership. This quiet transfer reflects a growing preference for certainty over promises, especially in an environment where confidence in financial intermediaries continues to erode. From Holter's perspective, This shift alters how silver should be understood going forward. With supply growth constrained and demand tied not only to investment, but also to essential industrial uses, price becomes the only mechanism left to restore balance. He suggests that future moves may not unfold gradually, as market participants are accustomed to, but instead arrive through sudden repricing once accessibility tightens enough to expose underlying shortages. If that adjustment accelerates, the key issue will no longer be short-term volatility, but whether the market can adapt to a new reality where physical availability, not paper liquidity, sets the tone.
2026, you're going to see an unwind of the credit markets. I think everything is going to unwind in 2026. Do we make it to 250 years? To July 4th, 2026? I don't know whether we make it or not. I don't want this thing to come down. I even though life has changed dramatically from the standpoint of the way we grew up, it's still better than a system that goes down and a Mad Max scenario where financial markets don't work. You can't get gasoline, you can't get food. That's where we're headed. And that will be caused by credit markets seizing up. Go back to 2007, 8, 9. The reasons for that happening still exist, but they're bigger. I mean, nothing was fixed after 2008. Nothing. All they did was double down, and double down. So now there's way more debt. Now there's way more money supply. The balance sheet of the Fed basically blew out tenfold in 2008. Went from 800 billion to 8, 9, 10 trillion. No, I mean, it's a progression is what it is. And I guess the best way you could look at it is it's a flame out, because the debt gets so large. In order to pay that debt, in order to pay the debt service, they have to increase the money supply. And what that does, if you think of the money supply as a pie, the money supply gets bigger, but there's way more slices to that money supply. So each slice is worth less. And that's the purchasing power. That shows, the purchasing power drops. People look at the movement this year in gold and silver and say, wow, gold went up. Wow, silver went up. Well, yeah, they do move against each other, but no. An ounce of silver today is that same ounce of silver back on December 31st. An ounce of gold today, same ounce of gold it was December 31st. The only difference is how many dollars, how many euro, how many yen, how many British pounds, Canadian dollars, whatever you need to purchase that ounce of gold or ounce of silver. And because they've dropped in purchasing power, that's the reason the price of gold is higher and the price of silver is higher. Nothing happened with the ounce of gold or the ounce of silver. What happened is the purchasing power of the fiat currencies basically collapsed this year. Right. Well, first off, again, understand that gold and silver for years and years have been suppressed with paper prices or with paper contracts being sold to dilute their value. So you're getting some catch up on that. You're getting catch up on silver because it comes out of the ground at less than 10 to 1 as far as the mining, but yet it was priced at one point at 120 to 1. Took 120 ounces of silver to buy 1 ounce of gold. We're now down to 64. I think on this move, you're probably going to see it well under 50. And you very well could see it under 20, under 30. The historical norm was 16 to 1. And it was discounted to 16 from 10 to 1 because you had to carry 10 times the amount of silver to move the same amount of money. But just understand that gold and silver themselves are money. End of story. Are there any other things that you can use? Well, yeah, if you have farmland, you can grow stuff and sell it and eat it yourself. Ammo is not a bad thing to have. You can barter with that, and you can also protect yourself with that. Storing up food. Anything that you have can be bartered. So keep that in mind when you're preparing and stocking up. Think to yourself, if I didn't have this, what I want, and what would I give for it?
The ongoing shift from paper-driven contracts to physical markets is poised to redefine how metals are valued on a global scale. As more participants demand immediate delivery, the gap between quoted prices on exchanges and the true availability of physical metal becomes impossible to ignore. Years of synthetic supply, leverage, and speculative positioning are now colliding with finite inventories, revealing the fragility of paper markets. This shift accelerates price discovery, as scarcity and accessibility start to dictate value rather than purely financial instruments or derivative trades. Markets that were once dominated by algorithms, margin calls, and speculative bets are increasingly responding to tangible demand, causing sharper price movements and exposing imbalances that were previously masked by artificial liquidity. The dynamics of supply chains, production constraints, and industrial demand are now central to how prices evolve, signaling that ownership of actual metal will hold growing influence over the future of the market. Over the longer term, this transition could fundamentally transform the relationship between investors and the assets they seek. Physical possession becomes a strategic advantage, while traditional benchmarks tied to paper contracts lose their authority and relevance. The influence of speculative trading, while still present, diminishes in comparison to real-world availability, pushing both gold and silver into a price regime defined more by reality than expectation. This realignment is unlikely to be linear, as periods of extreme volatility may punctuate the shift, while confidence in paper instruments continues to erode. If the trajectory toward physically dominated markets continues, are we approaching a moment where the balance of power in precious metals is permanently transferred from financial constructs to those who hold actual assets? Share your thoughts in the comments section below. If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.